Welcome everyone. Hope you're all doing well today. Thank you so much for attending this webinar. It is top of the hour, so I want to be respectful of your time and get started. I am Reneika Lightbourne. I'm truly and always delighted to have the one and only Mr. Bryan Ellis. He is a co-founder, publisher of SEI magazine, also a host and so many other credentials. Thank you, Bryan, as always. So Bryan's going to talk through, how to go about making smart investment decisions in terms of safeguarding against or not falling victim to manipulation tactics. So before I turn it over, I'm just going to give you a quick synopsis of what self-directing is, some of the steps to take when you're looking to get started with us. If you have questions, you can go ahead and type those in the question box. We can answer as we go and or allocate some time at the very end as well. Again, my name is Reneika Lightbourne. I'm one of the business development specialists here at Advanta. I've been with Advanta as an employee for about a little over 2 years now, but I'm also an active self-directed IRA investor client of Advanta for about a little over 4.5 years. If you have specific questions or you want to do a deeper dive relating to your scenario, always feel free to give me a call, send me an email, and then I encourage you to check out our website at advantaira.com as it's a great resource for you. A little housekeeping before we get started. Just know that at Advanta, we don't give any tax, legal, or investment advice. All of the information presented is just more so educational purposes. So we always encourage our clients to do your own due diligence, confer with your professional teams before making any decisions. A little history about Advanta and who we are. We have been in the business for nearly 20 years and is recognized as one of the leading self-directed IRA administrators in the business. We have headquarters is in Largo, Florida, Tampa Bay, but Advanta also is in Atlanta, which is where I'm based. But we do have clients nationwide as we have almost $2 billion under our administration. One of the ways that we separate ourselves is just providing our clients that concierge style service. So you have that direct point of contact as a client of Advanta. And then, of course, our educational platform that kind of give you a broad range of different topics and guest speakers and expert like Mr. Ellis. Just a few key takeaways when it comes to self-directing. First and foremost, know that any IRA or former employer plan qualifies. You choose the investment that works best for you. And then, of course, knowing that any income generated from that investment flows back into the IRA. If there are any expenses associated with it, it will be paid by the IRA. So exactly what is a self-directed IRA? It just simply means that you, as the IRA holder, have control over the retirement funds and the investment decisions. And it also gives you the option to really diversify your account. When it comes to like the different types of things you can invest in, just know you can currently invest in real estate, tax liens, notes and mortgages, precious metals, oil and gas, the list goes on and on. So exactly why do people choose to self-direct? You may look to self-direct for any number or combination of reasons. It can be, one, it's a new source of capital for you. Meaning if you have funds that's just sitting idle in an old 401k or a traditional IRA at say a brokerage firm, you can elect to transfer those funds to make your next investment. 2, the ups and downs in the stock market, whereas no one has control over that, but with a self-directed IRA, you're able to diversify your account, invest in the likes of real estate that we know always holds value. And then finally, the tax benefits, having those rents, those dividends, those profits flow back into your IRA account, tax-free or tax-deferred. Just bear with me. In terms of the different types of accounts that can be self-directed, just know, again, any type of IRA qualifies. So for individuals, whether it's a traditional IRA, meaning tax-deferred, you pay taxes later, or a Roth IRA, you pay taxes now. If you are a self-employed individual, have a small business, or you're 1099, a contractor, you can look to self-direct a SEP, simple or solo 401k. A solo 401k is very similar to the traditional 401k at a W-2 job. It gives you the higher contribution limits, a little bit more flexibility. Any former employer plan qualifies, like the old 401k through the TSP type plan. Also, some lesser known accounts that also can be self-directed include ESA's educational savings account and an HSA to cover medical related expenses. The HSA is dependent on having a high deductible plan. The key thing to remember is the contribution limits varies between the different accounts. And then with a Roth, the distribution is tax-free at retirement. When you're ready to get started, we've really streamlined that for you in 3 simple steps. Step 1, fill out the application to open up your account. We'll be there to guide you through that process. You'll be assigned an account manager. Step 2 is funding the account. That's including, transferring funds from an existing IRA, rolling funds over from a former employer plan, or a combination of, making an annual cash contribution based on the type of account that you have. And then finally, step 3, start investing. What is it that you want to invest in? Is it real estate? Is it notes? Is it private placement, and so forth? I'm going to hand it over to Bryan, but I do want to just kind of make you all aware, if you're not, feel free to, please, we encourage you to reach out to your local representative, senator, congressman, congresswoman. Right now, there's currently a proposed tax provision that's going to strongly restrict a lot of IRA investors, self-directed IRA investors, and this is more so, just the everyday average American middle class that's, trying to save for retirement. So we've provided a letter that you can send to your representative, but if you want to kind of talk more about it, feel free to reach out to us, and we can help you with that language or verbiage to set out. Bryan, with that, I'm going to go ahead and make you the presenter.
All right, can you guys see me okay?
Yes, I sure can.
Okay. Good. All right. Reneika, thank you. I am grateful to be with you today, as always. Ladies and gentlemen, first, just a couple of housekeeping things. The first one is that I find myself away from my office. For those of you who have been with me in past presentations, you know we generally do a really high quality job of audio and video presentation, and what you see behind me right now is not exactly the same as normal. So I apologize. There was no way around being away from the office, away from my entire state today, actually. So bear with me if you could. The second thing before I get started is this: the proposed legislation that Reneika just mentioned. That is a terrible. There is no good thing in that legislation. There are no good things in that legislation whatsoever, including including all of the impact on and bear with me 1 second. I'm getting some strange glare here. I'm going to try to correct. Well, it looks like it is not correctable, so I apologize. But anyway, this legislation is to describe it as a bad thing for IRA owners in general, and self-directed IRA owners in particular, is the understatement of the century. You may be told by some people who want to distract you from what this is really all about. You may be told that really all that it does is it changes things where people who have really big IRAs have to pay some extra taxes. That is not the case. Let me give you just one example. Most of what I do, for example, is that I share investment opportunities in the form of syndications. A syndication is when a bunch of people get together, they put their money in a pot, so to speak, and then they have somebody who knows what they're doing manage the pot and go invest it for them in an agreed upon way so that everybody does well. That's called a syndication, and whether it's a 506B or a 506C, there are legal requirements. There are standards that a person has to meet before they can participate in syndications like that. Well, under the new rules, you'd be completely prohibited from ever using your IRA in any of those types of projects. In any project where there are any standards whatsoever for participating, such that if not every single person is qualified to participate in a project, then you can't use your IRA to invest in that. Now, that's going to wipe out all syndications for you. It's going to wipe out anything and everything that is at a higher, more elite level, like the stuff that I deal with. It's going to be a very bad thing, and that is just scratching the surface. They are really destroying the IRA. And this is more than incompetence. This is evil, but that's just my humble, albeit entirely accurate opinion. All right, having said that, my friends, I'm going to share some information with you today that Again, it's going to be a little bit more difficult than normal, because normally I would be doing this with a pretty fancy production to back me up, but I'm just going to try and do it audibly, and I think it's going to go just fine. So, my friends, today we look at how your mind can be manipulated when a sponsor is trying to persuade you to invest in their projects. All right? So what I want you to think about is this scenario. Imagine that somebody out there has a great investment opportunity. It's probably going to be a syndication, like I mentioned just a moment ago, where what you have is where what you're doing is putting your money together with other people in an agreed upon way. That's a syndication. That's an investment partnership. And so imagine that somebody has one of those opportunities. Like, for example, I do these all the time, or I raise for them all the time. I'm raising for another oil and gas project this week, for example. We're doing a build to rent real estate project next week. That's a $7 or $8 million project. We're going to raise $2 or $3 million for that one, something like that. They're stacked up. Those are the kinds of things that I do, and that accredited and affluent investors tend to really enjoy investing in. And that label, accredited or affluent, does fit some of you, right? And so for that reason, I want to tell you a little bit about how these presentations that people make whenever they want you to invest in their project. I want to tell you a little bit about what goes on behind the scenes, because there's a lot to know, and it's a little bit disturbing. I'm going to share my screen here for just a second. And hopefully you see right now a piece of art that is illuminated, behind, rear illuminated. Folks, this is, I want you to take a quick look at this image. This is a famed tennis player, Swedish tennis player from the 70s and 80s, Bjorn Borg. Okay, take a close look at it. There's no funny business here, except that your mind is playing a trick on you right now. You see, your brain knows what a face looks like, and it interprets this piece of artwork as a face, right? It looks like a face, it's shaped like a face. To my mind, to yours, that's a fairly normal face, except it's almost exactly opposite of a normal face, because this face is not convex like my face and your face. That means that this face, the nose and lips, they don't point outward like my nose and my lips and your nose and your lips. It's actually concave. It's the opposite. It's an indentation. It's almost like a plastic mold taken of a face. It's totally pressed in. Not at all like any normal face you've ever seen. If you encountered somebody on the street with this face, you might run the other way, because it's literally opposite any other face you've ever seen. But my friends, your mind didn't tell you otherwise, did it? No, it didn't. It told you this was a normal face. Well, don't fret. My mind did the same thing. It's true for very nearly everyone who saw this image. Now, you might think of this as an optical illusion, but it's much more than that. It's actually a cognitive illusion, right? Now, with that, what I want to do is return to the reason that we are here today, and that is to help you to understand some of the sophisticated persuasion techniques that can be used for motivating you to invest your hard-earned capital. And this is so that you can recognize those techniques when they're being used, and when appropriate, counteract them, right? Now, my friends, I want to give you a little bit of context here. This persuasion thing for capital raising, it's something that I know really pretty well. It's just about all I do, in fact. When sponsors of private placements and investment partnerships, like I just mentioned to you, when they need to raise capital, many of the best of them pay me a whopping $25,000 per day for a single day of constant consulting in order to create a deeply persuasive webinar presentation that will help them to raise the money they need. Now, if we have time later, I'll tell you about some of the people who are my clients, because I do a lot of this. In fact, the last time I did such a project was literally yesterday. That was September 27th, 2021, for a rapidly growing boutique oil and gas firm in Austin, Texas. And that's actually the 5th or 6th such project I've done for that particular client. In addition to that, my tie to affluent investors is as publisher of the country's leading magazine for accredited investors. And I think Reneika probably doesn't even know about this one yet. We've recently launched this one, and it is going very, very well. It's called Accredited IQ. And in the pages of that magazine, we help affluent and accredited investors to have access to investment opportunities they just won't find anywhere else. We give them the tools and the knowledge they need to properly scrutinize those projects too, because, hey, not all projects are good projects, are they? So before we go too far, I'd like to welcome each of you. If it's good with you, Reneika, I would be happy to offer everybody on the line a free subscription to Accredited IQ magazine. It's only available to you while we're doing this webinar, by the way. But if you'd like that, just text your email address to me, and I'll give you the number here in just a minute. It's 678-888-4000, 678-888-4000. Just text your email address to me, and I'll get that taken care of as soon as we're off the line here. But here's what I want you to understand, folks. Here's what I want you to understand. The techniques that I'm going to share with you today, they're routinely used against you. Specifically, these techniques are used against very bright, very intelligent, very savvy investors like you when you're being pitched by people with investment opportunities. And to be clear, I don't use the phrase against you or used against you to suggest that anyone is necessarily being unethical just by using persuasion techniques. That is not my position at all. The techniques I'm going to share with you are in and of themselves totally benign and lacking any moral position, either positive or negative, right? Now, I use many of these techniques myself routinely. That's me. And somebody just texted in, so thank you for that, but I've got to turn off my phone so that it doesn't do that constantly for the rest of you doing it. These techniques are, like I said, in and of themselves totally benign, not positive, not negative. I use many of these techniques myself routinely with no shame, no guilt, and no ethical difficulty whatsoever. In fact, in our brief time together, I'll share with you a case study of a presentation where I use several of these so that you can see precisely what I mean in practice, in reality. So what I do mean in use of the phrase used against you, right, is that the techniques you're about to learn will frequently result in your changing your mind, or at the very least, it'll result in you softening to an idea that you previously resisted. And even though that you may think this is inherently a bad thing to have your resistance weakened, that's demonstrably untrue. And I need to make sure that we all understand this to start with. Here's a quick example. What if I used persuasion techniques to convince you, to persuade you to terminate the sustained consumption of processed sugars? Hey, nearly all of us are guilty of that one, right? Persuading you to make that change will make your life longer, it'll make your life healthier, it'll make your life better in every conceivable way. So the point is that none of these techniques have any inherent moral quality. You simply need to understand them so that when they're used against you, you can recognize whether the specific usage is ethical or not. So let's take a look at a few of these techniques now, beginning with a technique that I call strategic context. Okay,
Bryan, really quickly before you get started, can you provide the number once more? Several people's asked for it.
Absolutely. Yes, 678-888-4000. 678-888-4000. And all you got to do is text your email address to that number, and as soon as we're off the line here this afternoon, I will make sure that your free subscriptions are processed. Text your email address to 678-888-4000. And Reneika, I just sent that information in a chat to the organizers so that you have that there as well, hopefully. Okay, so the first technique is called strategic context. Strategic context. I call this kind of informally the my deal is better than Warren Buffett's deal technique. Hey, just think about it. If I was pitching a project to you and I could somehow have you think about my project as being superior to whatever you could get from Warren Buffett, then that would probably have a positive impact on your perception of my project, right? Of course it would. Love him or hate him, Warren Buffett is respected. So there's no need for the standard of comparison to be Warren Buffett specifically. He's just an easy example because everybody knows his name and he's very broadly respected. The point, in fact, is for the project sponsor, the person offering you a project to invest in, what they're trying to do is to borrow some of his credibility, some of the high regard that Buffett or whatever standard they're using actually has. This can be done ethically, and it can be done unethically. And I'll demonstrate how both of those work to you momentarily. But first, let's look at the 3 steps involved in this technique. Strategic context, so you can recognize it. First of all, whenever somebody is pitching you on a deal, they'll present you with something, most frequently something like a return on investment number. And they'll say, for my project, the return on investment is going to be X. The second step they'll take is that you'll be shown an alternative, something else entirely, which by comparison isn't quite as good as X, as the thing that they're pitching to you. And in the step 3, you'll be shown the superior impact of choosing their deal versus the other thing that they put in front of you as an alternative. So if the target project, we'll call it sample project. We'll just imagine that somebody's pitching a project to you called sample project. And we'll imagine that they are offering an ROI of say 12%, and 12% is, for whatever reason, it's being represented as a strong, desirable return. Then in that scenario, then here's how a crafty, not necessarily dishonest, mind you, just crafty sponsor might express that information. They could just say, hey, you're going to make 12% by investing here. Or they could do it smarter, and they could do it kind of like what I'll show you right here. For just a minute, ladies and gentlemen, I'm going to drop into performance mode, so to speak, and I'm going to present to you about a minute's worth of a script. This is an example of a piece of the kind of script that I would write whenever people hire me for consulting. And I'm going to use the strategic context technique in this little sample. It'll take about a minute. All right, so if I was delivering this actually, I would do something like, so after running the numbers, we're proud to tell you that sample project is expected to perform at a whopping 12% per year return on investment. 12% per year. And I want you to understand how significant that is. Just ask yourself this. Who is widely regarded as one of the greatest living investors right now, and maybe the greatest of all times? Well, it's Warren Buffett, no doubt, and his reputation is well earned. But did you know that even under the masterful touch of Warren Buffett, the Buffett stock, Berkshire Hathaway, has over the first 20 years of the 2000s, it's grown at a rate not of 12% or 11% or even 10%. When it's all said and done, Berkshire Hathaway has averaged closer to about 9% share price growth over those 20 years. Now, I say this not to speak ill of Buffett, far be it from me. We should all be so fortunate as to have his experience. But as a purely financial decision, understand this. If you invest $100,000 into something for 20 years, the real cash in your pocket difference at the end of those 20 years, if you get only 9% versus getting a whopping 12%, well, the real difference to your portfolio, the real difference to your retirement, the real difference to your lifestyle isn't 3 points. It's $405,000. It's $405,000 more that you'll receive from sample project versus something that returns 3% less. That's nearly $500,000 of difference, just because of the difference between the 12% you can enjoy with sample project versus other less lucrative opportunities. Okay, so out of performance mode now. That's an example of the strategic context technique. And the whole idea is to tell you not just that sample project yields 12%. That's good, but in a vacuum, that information has limited value. But we really want to show you that 12% is a really attractive result because it compares so favorably to a highly respected standard. In this case, Warren Buffett's Berkshire Hathaway stock performance. And by the way, all of that was true. Now, here's what I want you to understand about this, my friends. You know, of course, that sample project is not a real project. It's just a hypothetical for our use. But the rest of that information about Warren Buffett and the performance of Berkshire Hathaway, well, it's all true information that I just shared. So in this case, that technique, strategic context, yes, it's definitely a persuasion technique because 12% sounds better after I explain it that way than it does before. The thing that here is that it was used ethically. It was used truthfully. If the ROI, if the return on investment of that offering is really expected to be 12%, then what I've just shared with you would have been a totally reasonable way to express that to you and to make that particular ROI look as attractive as humanly possible. Now, you've probably seen this technique used in the past, and you'll certainly recognize it moving forward in the future, but here's how you can use this knowledge to protect yourself in the future. The key is in looking at the point of comparison. In this example, the point of comparison was Berkshire Hathaway. Now, that is the point of comparison because I took that example out of one of my own presentations for a project called the Lake Huron Campground Fund. And I wanted the point of comparison to be as strong as possible. Now, by the way, that project, the Huron Campground Fund, that was funded last year. That's gone and done. You can't participate in that. And we did that, by the way, during the height of the COVID lockdown situation. And that project has already gone on to absolutely tremendous success, by the way. Now, again, what I just showed you was a totally ethical use of the strategic context technique. I used Buffett from my point of comparison because you just can't have a better standard among retail investors than Buffett. He's like gold reputationally, but listen closely. My friends, that same technique could be used by an unethical project sponsor to get the benefit of comparing to Warren Buffett without actually representing the facts honestly. How could they do that? Well, let's just think about it. Instead of, you probably recall that I used a 20-year time horizon, 20 years worth of Buffett's performance. That's a long time. That's a long time. That's more than enough time for any down fluctuations or craziness in the stock prices or craziness in the general market to have worked itself out. That's a long time. But instead of using a 20-year time horizon like I did, an unethical person may choose to use a much shorter period of time during which Buffett's numbers were even lower than 9%, or maybe even negative. Maybe the unethical project sponsor picks a 90-day or a 30-day period during which Berkshire Hathaway stock performed dismally to make their project look better. Look, such a period can be found for any publicly traded stock. I don't care which one it is. If that's what somebody does, if they compare what they are proposing to you to a clearly weak period of time that is atypical for their point of comparison, whether it's Warren Buffett or the S&P 500 or whatever it is, if they're picking out the weak period of time rather than a legitimate span of time that shows what really happened, that could be an indicator of a real problem, of somebody being unethical with really powerful and legit persuasion techniques, but that they're using badly. Or maybe, by the way, maybe instead of comparing to the ROI of Berkshire Hathaway, the sponsor could instead attempt to make himself look better by comparison by pointing out mistakes Buffett made. For example, last year, during the COVID crisis, Buffett dumped a huge position in Delta Airlines stock. Well, it was just a matter of months, if not weeks, before that stock recovered to the point where it had been before and boomed upward. You know, last year ended up being a really solid year in the stock market. So Buffett looked really pretty bad. He looked really pretty bad as a result of that. And so what you could have done is kind of point out that, hey, here's this guy, and this is he's the man, you know, the man. Look what he did. Look what your alternative is if you don't do that, if you do something better instead. Well, you know what? It's a legitimate thing to criticize that decision. But the reality is that that's kind of an exceptional thing, an unusual thing. Buffett has a pretty good track record over time, but if that's what somebody harps on, again, what you have is somebody who is choosing to compare their deal to a weak standard so that they will look good. And the only reason you do that is when your offer itself is weak. Both of those examples, an extremely short timeline, if you're looking at stock performance, or maybe focus on one specific poor decision. Both of those examples are it's a less ethical and it's certainly a less helpful way for information to be presented to you. But that specific part of the strategic context technique, the comparison to a point of reference, is where you can tell if the project sponsor is serving your interest or theirs. I mean, it's simple, really. When you hear someone comparing their own performance or their proposed performance to a third-party standard, ask yourself this: is the point of comparison a respectable standard? Buffett's respectable, the S&P 500 is respectable. There are lots of respectable standards. So the first thing to ask yourself is this a respectable standard to which they're comparing? Then the second question to ask is it a reasonable usage of that standard? Like in my case, I used a 20-year performance of Buffett stock. But if you wanted to pick out a negative 90-day or 30-day period, you could do that. But it wouldn't be a very good representation. You see, if someone's usage of this strategic context technique fails on either of those points, if they either use a standard that's not respectable, or if they use that standard in an unreasonable way, then what you have is a project run by someone whose standards of ethics may in fact be quite questionable. All right. Now, what do you want to look for? A strong point of comparison, a reasonable usage of that standard. That's what that's the game. Now, let me give you an example. In the case of the Lake Huron Campground Fund that I mentioned a moment ago, the project that we raised last year, the comparison to Buffett's 20-year results was even more dramatic because the IRR for the Huron project was projected to be solidly 25% plus per year. And in actual fact, it turned out to be even better than that. That, by the way, is the kind of opportunity to which I expose subscribers to an accredited IQ magazine. So I haven't been able to check my phone to see how many of you have gotten in yet, but that would be a good reason that you would want to. Those are the kinds of things that we actually connect you to. Now, when I was pitching that project, the Lake Huron Campground Fund, and I compared it to Buffett's 9%, well, the contrast was really, really stark, really bright, really attractive, but it didn't stop there. And we'll just stick with the Huron Campground Fund as our operational example for the moment. And I'm going to demonstrate to you the next superpower psychological technique, which is called the appeal to a higher authority technique. And my friends, I want to reiterate to you why I'm doing this. I'm not doing this so that you can go out and become super persuasive yourself. What I want to do is teach you these techniques so that you can know when they're being used on you. And look, these can be used entirely ethically, as I'm trying to express to you here, or they can be used entirely unethically. And when they are being used ethically, that's actually a very good indicator because these things are easy to manipulate. All right, so before I show you how an unethical project sponsor could use the appeal to a higher authority technique, I'll show you how I actually used it in a totally ethical manner. So I just mentioned to you about the Huron Fund. It was being pitched at an internal rate of return of 25% plus per year. Now, I've been raising money for a long time, and whenever an ROI is that high and it gets quoted as being what's expected, the BS-o-meter of savvy investors certainly tends to go off, as well it should, right? But when you can provide overwhelming support to your claims, that skepticism is actually a really helpful thing, because when that skepticism is satisfied, the investor tends to want your thing more. So for just a moment, I'm going to drop back into presentation mode, and what I would normally do here is share a slide with you from the actual Lake Huron Campground Fund presentation to show you how I use this technique. I don't have that slide because I'm not in my studio right now. But if you saw that slide, all that slide would have on it was a picture of two guys. One young guy in mid-30s, his name is Daniel Medina, and another guy named Chris Calavocas. He's 76. He's a little bit older fellow. And that's all you'd see is a picture of those two guys with their names. So bear with me for a minute. Again, I'm going to drop back down into presentation mode, so to speak, and tell you and give you a sample of how I use this technique entirely legitimately. So I'd like to introduce you to the managers of the Lake Huron Campground Fund, Mr. Christopher Calavocas and Mr. Daniel Medina. Both of these gentlemen see opportunity from a perch of much greater visibility than most of us enjoy. And they have the experience and the resumes to prove it. Chris Calavocas' fingerprints can be seen all over the upper echelons of Wall Street. At 76 years old and with literally 50 years of experience in the financial world, Chris's firm, RER Financial, is one of the premier analytics and due diligence firms in America. His client roster is like a who's who of the financial world, including Goldman Sachs, BlackRock, Merrill Lynch, Carlyle Group, Citigroup, Deutsche Bank, Fortress Investment Group, and literally dozens more well-known, highly respected companies. Now, whenever firms like these need a very conservative, careful eye to evaluate their loan portfolios, their real estate projects, and other alternative financial assets. That's when Chris and his RER financial firm gets the call because of his long, deep relationships as a key provider of due diligence services to the very best companies on the planet. And one of those companies alone, Fortress Investment Group, the huge private equity firm with over $41 billion under management, well, just at that firm alone, 3 of the most senior executives of that firm learned directly from Chris when they worked for him at RER over the years. But he's not just an analyst par excellence. So he is that, and his firm certainly is at the highest level. He's also a wildly successful investor himself. I'll tell you more about some of the projects he's already done and that he's already closed and he's already profited on in a bit from now. But here's something in particular that's special about Chris. In his 50+ years of investing, he has never been the target of a lawsuit. He has never declared bankruptcy. He has never defaulted on a loan. This man has an exceptional, sterling, impeccable reputation. And Mr. Calavocas is so confident in the pro forma for this project and the 25% plus projected ROI therein that he's staking that impeccable reputation on it. Okay, so no longer in presentation mode, my friends. In that example, my goal was simple: to give investors a reason beyond just my words alone to believe that maybe, just maybe, this Lake Huron Campground Fund actually could produce a 25% plus ROI. And the way that I did it was to use 100% absolutely true information about Mr. Calavocas and his experience and background, particularly since he's literally at the upper echelons of due diligence and analytics of alternative projects for major Wall Street firms. I mean, it does not matter how hard you try. You just can't find any reason in this guy's 50+ year career not to believe him. So in this case, who is the higher power? We're using a higher power technique here, right? Well, it's that long list of clients that Mr. Calavocas' firm has or is serving. There's nobody above those firms on the chain of prestige, period. And each and every one have or currently does work with Calavocas. That is the appeal to higher authority. Now, that's a great example of how that technique can be used in a 100% ethical, honest, and genuinely helpful way to motivate investors to take action when they may have otherwise been unconvinced merely by the citation of an ROI claim. I suspect you can see now why my citation of a high number, 25%, is something that we were able to sell to people, to persuade people was a legitimate thing, because that's what this guy does. That's what he does. That is his expertise. The best companies in the world call on him for that reason, to analyze their projects and to project how well they'll do. And that's what he said about this project. So here's the question: how could this same technique be used negatively to cause you harm? And how can you recognize when that happens? This technique is used in an unethical or at least questionable way more than any other. So I want you to listen to me very closely here. There's not any specific and absolute signs that the project sponsor that you're hearing from is not legit just because they are using this technique. I mean, it can be used legitimately, but there are good clues that you can watch for. And one of them is do they never appeal to any higher authorities at all? Do they never appeal to any higher authorities? In other words, do they never refer to any third-party verified successes that they've experienced in the past? Is there nobody with a notable reputation who vouches for them? Have they never been published in a reputable magazine or other publication? Hey, none of those things are specifically necessary to be clear. A person could have a great offer and be totally ethical and have none of those qualifications. But if your project sponsor, if they have absolutely no solid third-party evidence that they are as great as they say they are, then at the very least, what you need to do is ask yourself, why is that true? Why don't they have any evidence that says that they are as great as they say they are? Now, another thing to watch out for, which in and of itself, here again, this is not a bad sign, it's a caution sign. And what it is this. When you see a project sponsor or a presenter who uses the logos of very well-known publications or organizations, but they don't give you any evidence of actually being connected to those organizations, that's a caution sign. A great example of this is that, I hate to pull this one out because you've got to be very, very careful, but this is frequently done. It's very common for project sponsors to simply hire a press release service. You can go to, oh my goodness, I'm drawing a blank right now. There are a number of press release services out there. You can hire them, pay them $200 or $300 to distribute a press release, which is then dutifully and nearly automatically published on many, many different media websites. And then some project sponsors will use the logos of those companies where their press release was published. They'll use those logos of some sort of suggestion that they've been published by or otherwise endorsed by that publication. So, you know, if you run a press release and your press release gets published on an ABC affiliated local TV website or a NBC affiliated radio station or on anything at all. Well, what they're doing is they're taking those logos and putting them in their presentation as if there is some sort of a third-party endorsement. Now, when somebody uses the logo of a third-party company, check it out to make sure they're legit and not just citing press releases. Using this press release tactic that I've just mentioned, it does not inherently mean that the project sponsor is dishonest. It might just mean that they're new to running projects on their own and they don't have a whole lot of third-party validation yet. And even that doesn't mean that they're going to do a bad job for you, but it definitely does mean that you should dig a little deeper to make sure that the qualifications and the associations that are being claimed by that sponsor are legit. For example, when I do the presentation for the Lake Huron Campground Fund, there's a slide in there that addresses my background and my qualifications as the presenter. Here again, I would show it to you if that were possible today, but it's not. But my background screen, it references my work in Forbes and TheStreet.com and Entrepreneur and other top tier publications. And it also references the tax law course about self-directed IRA tax law, no less, that I teach for attorneys through the University of California's Continuing Education of the Board. The real point here is simply this. I really have published online in Forbes. I really have published in The Street. I really have published in Entrepreneur and these other places. It's real, it's verifiable, it's not questionable, it's not just press releases. So that's a bit about how the appeal to a higher authority, to a higher power technique, can be used entirely legitimately, like I showed you with Chris Calavocas, or it can be used more questionably, leading to an indicator for you to dig a little deeper. Now, there are actually many more of these persuasion techniques that can be used for good or evil. And before I share one more of them with you, I want you to understand something, my friends. You probably think that you're a rational, reasonable, logical person. In fact, we all think that. But what we actually are is not rational. What we are is rationalizers. This is a human condition. It's not specific to me or to you or anyone else. It simply means that when we have to make a decision, we form a strong impression or a preference, usually rather quickly and automatically. And then we look for information to support that decision. We're looking to support the decision we've already made, rather than collecting information and then necessarily making a decision from that in that order. Look, this is neither positive nor negative. It just is. And it's true for all of us. But this is actually where you should be glad and grateful that strong persuasion techniques actually exist, because, my friends, psychological research makes it very clear that your initial opinions of a particular decision are far more likely to be made on the basis of a split-second built-in bias rather than well-considered reasoning. So, if a life-changing investment opportunity comes your way, and you happen to have a built-in prejudice against that opportunity for some reason, then your only hope of not making a really bad decision, your only hope of participating in that project, even though you have a basic bias against it to begin with, your only hope is that you maybe could be persuaded. You could be persuaded by someone who understands the proper use of these techniques. That's also why you need to understand how to recognize when those techniques are being used against you by project sponsors who might be less than scrupulous, or who are maybe just inexperienced and, well, I don't want to say desperate, but let's just say highly motivated. Because what we're talking about here, my friends, we're talking about your portfolio, your investment capital, the financial sum total of all of those long nights at the office, all of those missed t-ball games, all of those vacations that were just a little bit shorter than they really should have been. What we're talking about here is your future, and it deserves real care and real respect. Now, I had hoped to get to share two more techniques with you, but I do want to be able to take some questions and such. So I might do one more technique here very quickly, and then I'm going to remind you that if you find information like this to be beneficial to you, if you like the idea of having access to genuinely elite investment opportunities, along with the tools necessary to honestly and correctly evaluate them, then Accredited IQ magazine is for you. And a free subscription has been arranged for you already, courtesy of Reneika, so you need to thank her for that. But you can reserve your subscription, your free subscription, which, by the way, is normally $60 a year. You can reserve your free subscription to Accredited IQ magazine by texting your email address to 678-888-4000. But you do have to do this while we're on the webinar. Afterwards, that offer is gone. Now, the last technique I want to share, and Reneika, I kind of like to get your input here as to whether I should take another 5 to 6 minutes to introduce another technique, or if maybe we ought to just stop and do questions now.
No, absolutely. Take the time. I did have another question. That do you have slides available to share with the group?
I do. Not today, but I do.
Okay.
Again, apologies, ladies and gentlemen, that I did not have all of that available to. I'm actually down in Florida, which is not where I live. There's a dear friend of mine is in need of some help, and I had to come down here rather abruptly. So I apologize, ladies and gentlemen, but I'll be happy to get you some slides. No problem there.
Okay, yeah, but take the time to go through the next.
Sure. So the next technique I want to share with you is called scarcity quantification. Now, this is a powerful one. This is a really powerful. It works on you. It works on me. It works on everybody. You see, persuasion techniques, they can't necessarily take a person who let's imagine that we have a continuum, like a semicircle. And on this end of the continuum is an absolute no to whatever you're offering. And on this end of the continuum is an absolute yes. Generally, we can't take a person who is an absolute no and make them an absolute yes, because not everything is right for everybody. We wouldn't want to do that, right? But what we can do is we can take people who are not absolute no's, maybe they're leaning no, or maybe they're kind of in the middle, and we can do things to kind of tip them over in the direction we want them to go. This is done on you all the time. You will recognize this. And you may be inclined to think that it doesn't work because it is so simple, but it does work. It's called scarcity quantification. Here's what I mean. I'll give you an example of it. Most project sponsors, whenever they present an investment opportunity, they'll say something like this. We've got to raise $5 million, and the minimum investment is $100,000. We've got to have all the money in by 2 weeks from tomorrow. If you have any questions, give me a call. We hope you'll get involved. And they will have spent the last 15, 20, 30 minutes going over spreadsheets and giving you justifications and that sort of thing. Now, here's what I want you to think about that. Is there anything about the way that I just said that is appealing to you, that makes you want to participate, or that increases your urgency to a higher degree? No, there's not. So what people respond to is things that they understand. And so what I might do is something like this. Let's imagine that there's a project, we're raising $2 million. We've got to raise $2 million. It's minimum $100,000 investment. Here's how I would do it. I would say something like, ladies and gentlemen, this project requires only $2 million of capital. Now, to you, that's a lot, but to a typical syndication, that's nothing at all. Just last month, $158 billion. And by the way, I'm making up that number because that's something that we can look up. I'm making that up, but it's probably not far off the mark. Last month, $150 billion were raised for syndications just like this one. We're raising only $2 million. We're expecting this one to go very, very quickly. The minimum investment, the capital quality that we require for this project is $100,000 per investor. Now, I realize that some of you are going to want to invest more than $100,000. I cannot promise that to you. That is a decision we make on a case-by-case basis. $100,000 is the standard unit. That means raising $2 million, we've only got 20 spots available, only 20 spots. There are far more than 20 of you on the line with me right now. And so the probability that everybody who wants to get to participate will actually get to participate is very low, because once we get investor number 20, investor number 21, and everyone thereafter, they're out of luck. So there is some urgency. We do have a limited need for capital. We only need $2 million. We only needed $100,000 at the time. So if you would like to participate, if you would like to be involved in this project, to be considered to be involved, what I want you to do is, then we'd of course have a URL that they could visit to apply. Now, ladies and gentlemen, think with me. I'm kind of out of performance mode now. I want you to think with me about that. The notion of having to raise 2 million or 5 million or whatever the number is, that's a big number to most people. Like, to most people, you're certainly not going to put in all $2 million. That's a lot of money, right? So the average person hears that and they think, wow, there's a lot of room for me to participate here. But when you do the math for them, when you say, no, there's a $2 million project here, but it's $100,000 per person, that means we've only got 20 spots. Well, what that means as a practical matter is that if you're number 21, you don't get to play. Now, ladies and gentlemen, there's one thing that is true about basically all human beings, and that is that they really want the thing that's dangled in front of them that's just out of reach, or maybe just barely within their reach. They want it, but it's going to be something that they have to work a little bit to get. It's something that is just a basic part of every one of us. That's what this scarcity technique is all about. It's the whole idea of quantifying the opportunity that's before the people, that's before you in this case. Now, watch for that and listen for it, because that's something you actually want to pay really good, close attention to, because that one's a little bit harder to lie about. Generally, that sort of thing is going to be pretty true. And it means that if you ignore that one, and if you're investor number 21, you might actually miss your opportunity to participate. And like if you had been involved in that Huron campground project, right now you would be sending me presents because you got involved in that. So that's the third strategy that I wanted to share with you today, scarcity quantification. And we certainly don't have time to really give the final one a reasonable amount of time. So here's what I have to say to you in closing, folks. There's a tremendous amount of opportunity out there right now. There really is. And the best opportunities that I'm seeing are, generally speaking, they're not the one-off houses, and they're not the one-off whatever. Most of the best opportunities right now, this won't always be true, but right now, most of the best opportunities are in syndications. And so you really need to be able to listen to those presentations with a skillful and discerning ear to make sure that you're making great decisions, because there's no shortage of opportunities, but there's always a shortage of really great opportunities. And with that in mind, I want to give you one final opportunity to text your email address into me to get a complimentary subscription to Accredited IQ magazine. Again, just text your email address to 678-888-4000, and I'll be happy to make sure this afternoon that gets processed and you get added to the roll. So with that, Reneika.
Thank you so much, Bryan. I did have some question that came over. So one question is, what's the fourth technique called? I know you can't go into details, but what's the name of it? What is it called?
Tell you what, everybody who signs up for the magazine, I'll send them a summary about that.
Okay, perfect. That was one of the other questions. Can you share the slides with those of us who text?
Yeah, absolutely. Absolutely.
Okay.
That's not a problem at all.
Okay, I know we're almost top of the hour, but I just have two questions that was asked. What questions should investors be asking from the provider or syndicators when they're pitched like that, typically, to do better due diligence?
The most important thing is, have you done it before, and prove it.
Okay.
You know, if they've done it before, they can, and it's not certain, but they can probably do it again. That's a pretty good indicator.
Okay, and then how do you analyze the team? Like if they're based on the appeal to higher authority, like who are the team? Like how do you analyze the due diligence on the actual team that's building the project?
Yeah, that's a good question. It's really the same answer, and that is that you have to do a little bit of research. You have to do a little bit of digging. But what you want to know is that, has this team, and not just the leader of the team, but every member of the team, done their thing before? Now, if they haven't, that's not an automatic certain no, but it demands that you require more, that you perform more due diligence, just to make really, really sure that you've got people who know what they're doing. And even if they've never done it before, they could still be a good opportunity. But that's the kind of situation where it's wholly justified, Reneika, for a potential investor to say, okay, I'm interested in investing, but I'd like to have a personal consultation with this member of the team, and this member of the team, and this member of the team. And then you find somebody like that who you trust, who does a similar type of job, and have them on that call with you to pepper this person with questions. Because chances are you don't really know what to ask them to really find out if they know their thing. But if you get somebody else on your team to help evaluate them, that's a good approach that'll keep you safe.
Okay, one final question is, in absence of third-party validation, what is the best alternative?
So is this person asking as if they are an investor or someone pitching a project?
If there aren't any third parties to kind of authenticate, what's the best, I guess, option for them as an investor to validate.
It is always, it's always the case that a new project sponsor won't have any third-party validation. That is possible. But again, there in that case, that's where you need to really dig deep, get separate appointments with each member of the team, drill down into their specific background, and have someone with you. Like if you're talking to their property manager, have a property manager with you who really knows that business well. Maybe if there's a property manager that ran a prior syndication that you invested in, or one that you know and trust, have them on the line with you, and do that for each one of the key team members in the general partner part of the project. That's not foolproof, but it is a really good way to find out maybe if the plan isn't quite up to snuff, or maybe that it is.
Thank you so much, Brian. And that covers all of the questions. I know I want to be respectful of everyone's time. It is 1 hour. Let me just go ahead and switch back to my screen. So again, if you have any related questions, to self-directing, or, you want to just go more in depth, feel free to reach out to me. Brian, certainly provided his contact information, but you can also, check out his website, give him an email, send him an email. Thank you everyone for taking the time to join this webinar. Have a good one.